Getting this money out means it produces taxation because they know that there's $38 trillion in there.
When you have self-directed, and you want to grow your wealth,
yep,
basically tax deferred, but then you're taxed like when it comes out, like it almost seems like it's more advantageous for the government to do that because you're growing more. And then as you've grown, right, you're going to get taxed more on the back end because you've increased your brackets and all that kind of stuff. It's almost like getting taxed on the harvest and not the seeds. So can you speak to that a little bit?
Yes. Well, that's why okay. To speak on your point first, right? There's over $38 trillion in retirement plans today, or over $14 trillion in IRAs, and steadily increasing. Why is that? Because a lot of people bank their money away in employer-sponsored plans, like your 401k plans, your SEP plans, simplified employee pension plans, simple plans, 403b plans, governmental 457b plans. Anytime you have a workspace environment that has an employer-sponsored plan, it allows for you to postpone or defer the taxation that you have. That's why the government likes it. Why? Because number one, Social Security is pretty strained right now. Eventually, they were really trying to mitigate risk or mitigate the amount of damage that's going to happen with the 78 million, what we call baby boomers, born between 1946 and 64. A little bit of history on that. That's why they passed a law called ERISA that actually snowballed a lot of these retirement plans that we're experiencing today. But it's eventually, they knew that they were going to be taxing these dollars. As a matter of fact, right now, last year, Richard Neal, the head of the Health Committee, Health, Education, Labor, and Pensions, was trying to introduce some laws that could actually speed up the process of getting this money out. It's like what you're saying. Getting this money out means it produces taxation because they know that there's $38 trillion in there. But we do have a magic pill on that because Senator Roth, in 1997, when he passed when the law called the Taxpayer Relief Act of 1997 was passed, it created a brand new account called the Roth IRA, which, as a matter of fact, the Health Committee doesn't like a lot because there's no taxation, right? I mentioned when we were conversing before we started the podcast, that distribution on those assets will eventually be what? Tax free. It's a little bit different. It's exciting, man. Imagine if you had a piece of real estate under your retirement plan, which some of your listeners might not know, that you could actually hold a piece of real estate in your retirement plan. Not only is the rental income not being taxed because it's received by a tax deferred account, eventually, once they've had that particular account for 5 years and they reach age 59 and a half, dead, we don't want that to happen, but it could happen, right? I mean, your beneficiaries would be enjoying that. That's why I volunteer myself to be a beneficiary of a Roth. And last but not least, that was a joke. And last but not least, if they become disabled, some people, as they get older, their health starts to dwindle down. Imagine if you become disabled prior to reaching age 59 and a half. Wouldn't you like all your retirement plan assets to be distributed tax-free?
Yeah,
that's
absolutely.
The power of a Roth. So in other words, those are the types of conversations and kind of questions, like brave conversations people need to ask themselves. Is this thing called a tax deferred account still working for me? Absolutely, because it reduces taxation, but eventually you're going to get taxed on it, prolonging your agony. But there's another solution to that, and that's what we call a Roth. With the help of their tax advisors and their legal advisors, they can determine how much to contribute to those, as well as they can even do what we call a conversion. A conversion is not a spiritual experience, but it could be, because they can actually take those assets that have never been taxed before, get taxed on it in the year that they actually put it to the Roth. In other words, they can move that to the Roth. Now, to speak to what you just said about, well, they're going to be in a higher bracket, so on and so on. We don't know what bracket system we're going to be in. As a matter of fact, in November of this year, we're going to have another election. You know what that means? New ideas are coming in, and everything again could change. How would you like it that you had the magic pill that even if they change the tax law, that distributions that are going to be tax-free will never be affected ever again by any changes that they do?
Yes.
That's why that Roth is very important. Out of the 4 different levels of taxation an individual could be subject to when they take money out of an IRA, as an example. And what are those? The federal tax. If you live in a state that has state income tax, in which I do, I used to live in Minnesota as well. I mean, you get taxed up. They have two seasons to fund, winter and road construction. So you have federal tax, state tax, and also this other thing called the federal estate tax. People that are high net worth, man, they're starting to dump assets. If you take money out of an account that's never been taxed before, well, can you really truthfully say that you're gifting that amount of money to somebody else? The answer is no, because every time you take money out, it increases the level of your taxation. But imagine if that was in a Roth IRA, that the growth has been growing under the Roth. And eventually, when you say, you know what, I've accumulated so much wealth, which is not a bad problem. I'd like to gift some of that money to my children today. Imagine distributing it tax-free, and it's not going to affect any of your taxation for that year. As well as individuals who are reaching that age where they're collecting what we call Social Security. I don't know if you know this, but Social Security is generally not taxable if your taxable income does not exceed certain thresholds. It's around $36,000 for a married couple filing a joint tax return, and it's around $25,000 to $26,000 for a single filer. If your taxable income does not exceed those particular thresholds, well, your Social Security income is not taxed. Imagine taking $100,000 out of a Roth IRA tax-free. What is that going to do to your Social Security? Actually, it's not going to do anything. In retirement plans as well, when somebody reaches a magical age of 72, they have to start taking what we call minimum distributions. In other words, that's where you were getting at. The government says, I've allowed for you to accumulate all this wealth this whole time. When you reach 72, it's my turn. You're going to have to take a minimum out. And if you don't take that minimum out, you get penalized. It's a 50% penalty. In a Roth IRA, there's no such thing. Imagine you reach 72, you have an apartment complex now on a Roth IRA earning. You keep in mind that rental income coming into the Roth is not going to get taxed. And if you need money to take out for your retirement, well, what is it going to cost you? Absolutely nothing, because it's tax-free. Tax-free for the rest of your life. Not only can you use it for retirement, you can use it for health benefits, because keep in mind the cost of healthcare is going through the roof. I don't know about you, but I'd like to take it out of an account that Uncle Sam does not have to touch it at all, nor the state. Right? So How many levels of taxation have we gotten rid of so far or minimized? 3. I don't know about you. I used to watch Sesame Street. 4 is more than 1, right? And if you live in a state that basically does not touch what we call people inheriting assets, and just like, that's why Florida, Texas, those are very attractive states, to live in. And some of them that I teach at, they say, you know what? You see those mailboxes, they're full of mail, right? But you don't see any people. The reason for that is they're someplace else, but they use those states as their permanent tax filing addresses so that when they pass away, the beneficiaries that receive those assets could minimize the amount of what we call an inheritance tax. Imagine 4 different levels of taxation, reducing that to none. Man, that's powerful.
Yeah, that's an amazing strategy.